Okay, this is part two. So we're just looking at a chart here. And what are the advantages of trading options over futures? Okay, and then we're going to subdivide the word trading because you're either buying options and then selling them, or you're either selling them and then buying them back. Okay. Now, most people, when they buy options, when they trade options, they are buyers. So we'll get to that in a moment. So let's say, for example, here with our sequence, and that's that takes time to learn the sequence, to commit it to memory, to understand the mindset of professional money, to learn about their historical place in the markets, what they've had to contend with, the criticism that they have received, the larceny and the chicanery that they have been involved with. My gosh, the political things that they have run up against. All of this we teach because you have to be able to reflexively understand what you're looking at on the chart, and that takes time. Okay. Once that is done, you're looking at a chart here, and we give you various tests that you have to take, and then we will know exactly how well you do, and anything that you've missed on, we review it, and that's why we go on the live market, so that you can see it occurring live. Because the average trader may say, oh my gosh, I've learned all this, but will it really work for me? Well, it doesn't change, because the reason why it doesn't change, guys, is because people, these people don't change. And the reason why they don't have to change is because they've got a very good thing going. I mean, a very good thing. What is the good thing that they have going? They've got a very large percentage of the public all using the same indicators so that they can pull their chain. They know that the average trader is using, what are you using? Keltner channel, moving average, CCI, force index, relative strength indicator, moving average, stochastics, fast or slow, Bollinger Band, of course. They know all of this. They know they know what's going to trigger order flow. They know. So, you have no edge. Remember, let's go to the stats. 80 to 85% of all traders, net losers. Why? It isn't because of intelligence. Hell, I'm sure many of you guys are smarter than me. It's not a case of intelligence. It's that you don't know the environment. So, the first step is to understand these bars. And by the way, irrespective of color, we should be able to turn these bars gray and shades of gray. It doesn't make a difference. Another illusion, by the way. Okay. So, now that you're able to read a chart, and by the way, your entry should dovetail our entry here because it's the same stuff. And now that that's done, we do not recommend that you trade the futures. Why? Because there's even more advantages that you can have at your disposal. Well, what are they? Good question. First of all, let's say, for example, we got a sequence, let's just say here. Okay? Price has been falling. There are what's called call options, which are options for price rising, that you are betting that price is going to rise, and there are put options, and that's betting price is going to go down. As price is rising, the price of the put options are becoming more expensive due to what's known as a volatility premium. Now what is volatility? Volatility is a way, or is a measure of the way an asset prices move, or the way the price of an asset moves, and it describes the dispersion of that movement. Okay, So volatility has its own realm, its own volatility, as its level moves up and down, and it moves at varying rates over time. It moves at varying rates over time. It can move fast over time. It can move slow over time. Okay? Therefore, volatility itself can be traded. Okay? Now, of course, you can't trade volatility on its own. It must be traded via an instrument. So, that has options. Okay? Volatility is a zero-sum game, meaning that for every winner, there is a loser. Okay? Holders of the option, and this is why we don't buy options. Holders of options have literally they have a gun to their head. They have to, the price of the underlying has to perform within the given period of time, because the option will expire worthless. It is a wasting option. It is a wasting asset over time. Okay, so the holders of these options, I mean, they're literally buying either lottery tickets, or they have bought them as a way of hedging their position in the futures market, and they know that it will expire worthless, but that's not why it's there. It's there simply as an insurance policy. Okay. All right. So the volatility behaves, the level of the underlying asset, it behaves independently of that. Okay. So it moves at varying rates. Therefore, when we get a signal here, the put options are mispriced. They're overpriced. Okay. Therefore, we want to be the seller of that, and we hedge ourselves by putting on what's a spread. Okay. So, let's say, for example, here, we got a signal here. We sell the volatility premium, which is overpriced, so we're going to sell the 103, 1025 put. Now, what are the biggest problems with trading futures? Number one, there's a margin requirement, standardized margin requirement for futures. Cannot do anything less than that unless you trade the mini. And that's it. Okay? With the options, because you're hedged, you can trade as little as one. Challenge number two. We have it number one. What's the quintessential problem that all traders face? Where do you place your stop? How many times have we heard that? Where do I place my stop? Where do I put it? Jeez Louise, do I put it too tight? Risk getting stopped out? Risking my stop tag and bag? Risking them hitting my stops? Do I use a mental stop? Do I use a tight stop? Do I use a loose stop? They're always playing with that. Do I use it where do I put it? Do I put it below the low? Do I put it below the close? What do I do? That's been going on since time immemorial, and it will continue to go on. Then price is, goes down and it goes back up, and now you're pissed. Okay. And then let's just start with the futures. If you went long here, for example, you only make money if price goes above that level and higher. You lose if it goes below there. If it goes sideways, it's of no consequence. Time is not a factor in your favor. Okay. So we want to sell the 103, 1025 put. So we sold the inside strike. So the 103, anything above, all the way down here to 103, anything between here and here is great news for us. Literally, you could say that's your stop. That would be a pretty wide stop if it was futures, wouldn't it? Huge. 80 cents. Could you imagine trading an 80-cent stop? There's no way you could do it. Okay? You can do it with the options. Okay? So it's way down there. So, reconstructing this This only moved 20 cents. Only 20 cents. So if that would be in the future is a $200 profit, it's 10 cents per penny. I think the margin's right now about 3,100. A 6% return. The same move in futures, 103 was now your cushion. All above that is positive to the seller. Time decay works to the seller, you, in sideways movement. And because you're initiating a spread, you can sell as little as one option. Now this small move resulted in about a 12% return on the option, on how much you actually put up. Listen, if there was a bank that was paying 5% per year, people would be lining up in the streets to put their money there. Okay? Only in the markets do traders turn their nose up at this. The secret is to combine statistical probability of success with capital. That's what professionals do. The general public takes a hell of a lot of risks because they don't have a lot of capital. And that combined with ignorance, and I don't mean that disrespectfully, ignorance just meaning not knowing the environment, using lagging indicators, buying high, selling lows, buying breakouts, all of those things. You could never buy breakouts. You could never successfully, in my opinion, trade options buying strength or selling weakness. The reason being is that you're buying the option that has been marked up with volatility premium. Warren Buffett said that Berkshire Hathaway was the biggest mistake he had ever made buying that company. Read his autobiography. I did. Biggest mistake. He should have taken that money and bought more insurance companies, because insurance companies collect premiums just like we're doing up front. We're going to go to part 3 here. We'll pause this for a moment.